a very warm welcome to you, and thank you for joining me on the very first episode of Beyond the Backtest, the systematic trader's journey. We begin today with a topic that cuts right to the heart of things, an episode I've titled The Systematic Mindset, Beyond Buy Low, Sell High. Now, we've all heard that advice, haven't we? It's treated as gospel, but I find it's often more of a hindrance than a help. So, let's start with a rather provocative question. What if the secret to consistent trading isn't about the heroic act of predicting the market's next move? What if, instead, it's about the far more attainable goal of building a repeatable, robust, and almost emotionless process to navigate it? That's the journey we're starting today. So, let's take a closer look at that old chestnut. Buy low, sell high. On the surface, it sounds profoundly simple, doesn't it? But you might find, as I have, that it's actually a beautifully disguised trap. The fundamental problem is one of definition. What precisely is low? And when do we know we've reached high? More often than not, these points on a chart are only visible with the crystal clear benefit of hindsight. In the moment, however, when a price is falling, buying low feels rather like trying to catch a falling knife. Our every instinct screams danger. And conversely, when an asset is soaring, the greed-driven temptation to hold on for just a little bit more can be overwhelming. It's like attempting to navigate a ship through a raging storm with no compass, relying solely on feel. You might get lucky, but it's not a reliable strategy for reaching your destination. What I found works better is to build the instruments first, before ever leaving the harbor. So, if relying on feel isn't the answer, what is? Well, this is where you might find it helpful to shift your entire focus away from predicting and towards preparing. This is the very essence of the systematic mindset. I like to see it as a framework for making decisions based on predefined rules, hard data, and probability, not on gut feelings or the day's market noise. It's helpful to think of the contrast like this. The purely discretionary trader is much like an artist, relying on intuition and a unique touch to create a single, beautiful trade. But the systematic trader is far more of an engineer. The goal isn't to paint one masterpiece. Instead, our objective is to design, build, and maintain a robust machine that can operate effectively over and over again, building for consistency, not the single moment of brilliance. So, if we're going to be engineers, what are the schematics for this machine? I find it helpful to think of any trading system as being built upon three core pillars. The first, and the one that fascinates everyone initially, is the entry and exit logic. This is the when, the specific signal that tells you when to buy or sell. But here's the thing. Most aspiring traders spend almost all their time here, endlessly tweaking this one part. In my experience, you might find that long-term success has far more to do with the other two pillars. Pillar 2 is position sizing and risk management. The how much. How much capital do you commit to an idea? And Pillar 3 is portfolio construction. The what. What collection of assets will you trade? In the grand scheme of things, the how much and the what almost always end up being profoundly more important than the when. Now, this idea of system over instinct isn't just theory. You might find one of the most compelling pieces of evidence in a rather famous story from the trading world. It revolves around a wager between two legendary traders, Richard Dennis and William Eckhart, who debated whether great traders were born or made. To settle it, Dennis recruited a group of absolute novices, people from all walks of life, and taught them a relatively simple mechanical set of trend-following rules. He called them his turtles. The results were nothing short of extraordinary. Over the next few years, this group, armed only with a clear system, reportedly earned hundreds of millions of dollars. What I find so powerful about this story is that it proves the core principle we're discussing. The magic ingredient wasn't some innate talent. It was the system, and crucially, the discipline to follow that system without deviation. A good process executed consistently can indeed triumph over raw talent. So, if these systems are so powerful, you might rightly ask, why doesn't everyone use them? Well, I find the barriers are rarely technical. They are almost always psychological. The first great hurdle is our own ego. There's a powerful, seductive narrative in being the hero who outsmarts the market, the lone genius who saw what nobody else did. Following a pre-written set of rules feels, well, it feels less heroic, doesn't it? It lacks that dramatic flair. Then there's what psychologists call action bias, this deep-seated human need to be doing something. A good system will often signal that the best action is no action at all. But to sit on your hands while the market churns can feel impossibly passive. We want to tweak, to adjust, to intervene. You might find that trusting a mechanical process goes against some of our most ingrained human instincts, making the simple act of following the plan one of the hardest things we'll ever do. So, how do we move from this mindset to the actual mechanics of building a system? For me, this is where data becomes your compass. A systematic mindset, you see, demands proof, not just a good story. And I found that historical data provides the perfect laboratory for this. The process is known as backtesting, and it acts as the bridge between a promising idea and a viable strategy. Now, it's absolutely crucial to be clear on our objective here. What I find is that the goal isn't to build a perfect prediction model, a crystal ball for the future. That's a fool's errand. Rather, you might find it far more useful to use backtesting to understand a strategy's statistical edge and its expected personality. How does it behave in different market regimes? It's about building a robust character profile for your system so you know its strengths and weaknesses before you commit a single penny of real capital. Now, all of this can sound quite theoretical, so you might be asking, what's the very first practical step I can take today? Well, what I've always found incredibly powerful is to begin with a specific kind of journal. I'm not just talking about logging your entries, exits, and profit or loss. What I find far more valuable is adding one crucial column, the why. For every single trade you consider or take, you simply must write down the reason and be brutally honest with yourself. Was this decision prompted by a predefined rule from your system? Or was it a reaction to something you felt? A surge of greed, a pang of fear, or perhaps even just the nagging desire to do something? You might find this exercise incredibly illuminating. The objective isn't to judge yourself, but to build a clear, data-driven picture of your own behavior. This self-awareness is the bedrock upon which you can begin to systematically identify and replace those discretionary habits with robust, rule-based ones. And as you build this self-awareness, you might start to notice the benefits of a systematic approach begin to compound in ways that go far beyond your account balance. What I find truly liberating is the drastic reduction in what's known as decision fatigue. Once your system is built, the heavy lifting, the difficult thinking is already done. You're no longer staring at a screen, agonizing over every tick. You are simply executing a plan. This, in turn, leads to a profound sense of emotional stability, especially during those inevitable market squalls. When others are reacting to fear or greed, You have a calm, logical process to fall back on. This is the crucial step that elevates trading from an anxiety-inducing hobby into a scalable, manageable business. The ultimate goal, as I see it, is to create a process that is durable, one designed to function flawlessly even when, and perhaps especially when, we as humans are at our most flawed. So, as we draw our first discussion to a close, if there is one central idea to hold on to, it's this. You might find that sustainable success in this field is rarely about chasing outcomes, but almost entirely about building and trusting a solid process. The systematic mindset we've explored today is the very foundation for that. But this, of course, raises the most challenging question. What I find is that building the system is one thing, but can you actually follow it when it tells you to do something that feels profoundly unnatural, to buy into a market panic, or to sell during a euphoric rally? That very battle, the internal one, is precisely what we'll be dissecting next time in an episode I'm calling Conquering Your Inner Enemy, the Psychology of Automation. We'll be diving into the psychological warfare of trusting the machine you've built.
If you find this information useful, we would really appreciate it if you would like and subscribe this channel to help others find us. If there are subjects you would like covered, please add in the comments section and we will include it in future episodes.